What's up? What's up, YouTube? Hope everyone's doing well. I'm doing this from home, so it might not be the best setting and the best quality, but yeah, enjoy my background. I hope you're all doing well, and it's good to be back on YouTube Lives. And there is not too much news to talk about today, realistically. Some things happened yesterday, and there were some effects in the market yesterday, but like what we got going on is we got the non-farm payroll numbers tomorrow, which they're the first of the month on first Friday of the month every month. So we're going to see what the non-farm numbers are like tomorrow. That's going to be a nice event in the morning, pre-market. But other than that, there's not too much that's going on right now in terms of news events to cover. Yesterday, what we saw was June 1st, meaning the Fed started quantitative tightening. So there was a sell reaction based on the start of the quantitative tightening. Obviously, that's not like one and done. I'm not going to claim to be a macroeconomic expert here and predict what the market should or shouldn't do based on quantitative tightening measures, but realistically, we've seen taper tantrums in the past, and this might be the start because the Fed announcement or the Fed event is coming up in a few weeks where we're expected to increase or hike rates again by 50 basis points. And with quantitative tightening, that's kind of a double whammy on the market. So we saw some downside pressure yesterday in the overall market, right? Exiting one of the larger distribution blocks and actually falling a decent bit before recovering a little into the close. Now, I don't know if we start to really see the effects of this quote unquote taper tantrum until there is more liquidity pulled out of the market, which would probably be in a few months realistically. And with the increased rate hikes, right, that's going to kind of add to the pressure of that so we can start to see the liquidity slowly evaporate instead of just one day, right? June 1st, and boom, we're done. We also saw the beige book yesterday. It's not like they released anything we didn't know. A lot of these Fed events that have been coming up recently and a lot of these quote unquote macroeconomic events, they're things that we already knew, right? Even Janet Yellen finally said yesterday she was wrong about inflation, which is shocking and upsetting that someone who used to be a Fed chair didn't realize what was going on or claimed to not have realized what was going on. I feel like they did. I don't know. They were just upholding some kind of image not to scare things further, right? That's probably the case. But in terms of fear, Jamie Dimon, who had recently requested a $53 million bonus, right? Shareholders kind of pushed that back, came on and talked about the financial situation, talked about the financial sector, right? And the financial situation within that sector. And it seems that his subdued fear before has now turned into larger fear in a sense, right? So JP Morgan CEO Jamie Dimon, right? He said that last month he was looking at this market and the quote and the overall economy and economic events, the macro structure of everything, and he was saying that, like it's gonna be stormy weather going ahead, but now based on what's going on, he's seeing more of a quote unquote hurricane instead of just a storm that passes by. So he noted that the U.S. economy is struggling with fiscally induced growth, quantitative tightening, and the war in Ukraine. So there's a lot of different aspects that are really combining and really going to push this thing on the brink. And of course, him being the JP Morgan CEO, right? Financials are going to struggle because of the liquidity getting pulled out of the market right now. So anything to do with financials, right? You got banks, you got mortgage REITs, you got like fintech, you got like even asset managers, insurance, whatever it is, right? Everything under the finance subsection pretty much closed the day red yesterday. And I think this could be the start of multiple different red sessions for financials. They're gonna feel it because a lot of the growth and a lot of the supply of money has really helped these sectors and these industries. And when it's getting pulled away from you, especially with quantitative tightening, increased rates, right? You're gonna see a massive struggle. So right now, things are okay, it would seem, but realistically, the polarity of what's about to happen in the financial world can be pretty devastating, especially with all of the liquidity balance changes. Because realistically, what had happened after 2008, 2009, right? When you go back to 2010, 2011, the major buyers of treasuries at the time were like central banks, foreign exchange managers, banks who were topping up their liquidity profiles, right? Because they all had the regulation for it. Now, all three of these aren't going to do the same thing that they did in 2010, right? Once they started actually tapering. So we can see that banks are topped up, right? Foreign exchange managers are topped up. Central banks will be selling rather than buying, and governments have much more fiscal deficit to finance. So it's a huge change in terms of flows of funds, which wasn't or which was seen in 2010, 2011. Right now, right after what we had done, right, we have a $10 trillion balance sheet. You're not going to see the same flows of funds, and there's nowhere really to go at that point, right? The liquidity is getting extracted, which means that we're going to see that heightened volatility. We've seen that the VIX has pretty much gone nowhere, realistically, even on these 9% rallies here from the lows. The VIX is still at elevated levels. And when we range and VIX continues to sustain like that, and VIX falls, even as the market falls, they're waiting for that massive catalyst event, right? That big potential limit down to really spike this thing. And right now, all we've seen is just controlled selling. So we've seen rallies, we've seen sell, but is it over? Not necessarily, because these macroeconomic policies have just started to come true, right? We've just started implementing them. So how could it be over, right? From a macro perspective in that case. So next rally, right? We could probably see a potential move to the upside in the coming days, right? I'm not super bearish about everything, but it's going to be a lot harder, especially with quantitative tightening starting. We have the Fed announcement mid-June, and the flow for a lot of options, right? A lot of hedges are to the downside for July, for the end of June, right? In anticipation of that double hike. So what we're seeing in that sense is, if this market's going to rally, it has to rally in the next 2 weeks, right? So whatever the non-farm payrolls are tomorrow, they better really do well to push this thing higher, because I'm still looking at that 42225, 42235 area, maybe max like the 70s, so I can start to see that there's going to be accumulation to the downside. Now, that's what happened last time around. We got this massive sell-off. So my expectation is probably not going to be met, and we're going to probably start selling before that. So I got to readjust that, but that's a target area where I want to see these buyers come in before that Fed announcement mid-June. So that's what I'm going to be focused on, right? A lot of the flow is still on the bear side, and I think there could be an interesting close to the month, to say the least. And we're in June, right? At the end of June, it's going to be the quarter end. So how this quarter ends is going to be very vital in terms of seeing how the following quarters really shape up. I'm still under the impression that dividend names and names that are heavy in cash are going to probably do well for the next year. But again, we have to see how this thing ends, because I am pretty bearish into the close of the quarter. Again, we'll see. So in other news, right, energy traders, energy headlines are coming true. Saudi even suggested to raise oil production if Russia's output falls, which was under the weight of the sanctions. And it's pretty interesting that they claim that they want to do that, because they were pretty against that and increasing production despite the recent oil price increase, right? So based on that news, crude did fall about 3% in response. And we're going to see where that shapes up. But they do want to increase the production. So remember, the EU leaders also agreed to a 90% ban in the Russian crude by the end of the year as a part of the bloc's sixth sanction package on Moscow. And another report from the Wall Street Journal on Tuesday outlined that OPEC Plus could suspend Russia from a supply deal due to economic fallout from the invasion of Ukraine and its ability to pump more crude. So the oil group is set to meet today, which is going to be interesting. We're going to see what they say and how that affects the crude oil market. So if you're a crude oil trader, for sure, take a look at that OPEC Plus meeting. And it's going to meet for its June meeting. And while expected to maintain production, leader Saudi Arabia may announce an immediate supply boost or bring forward production increases for September, realistically, not exactly now, if the climate is right. So what that is going to do, probably put some downside pressure in crude. So we've seen that gas prices have been super elevated, and that's one of the biggest mandates that we saw in the meeting between Powell and Biden, right? Biden pretty much said, you know what, the Fed's going to do whatever the Fed's going to do. The top economic challenge right now in the U.S. is going to be inflation, right? It's not just gas prices that are increasing. It's everything around you that's increasing, and they want to fight these higher prices, and they're going to let the Fed do whatever the Fed has to do for these inflation numbers to come down, which brings a lot of autonomy, and for that reason could be pretty detrimental for the market. So we'll see how that shapes up. Of course, there's a lot of different factors. There's a lot of macro analysis. There's a lot of internals to read into, but we'll see how this shapes up. I am like medium term, I guess, bearish in a sense based on the macro events, but the next move ideally is to the upside. So I hope you all enjoy this and are ready for the trading day. We're going to see what's going on. I haven't even looked at the market in the past like 30 minutes or so. Last I checked, we were battling at that 4120 on the S&P on the futures. So acceptance above the 4130s or so, we really get into that distribution block, which could push us higher. If we keep rejecting the 4120s, right, remember you have that key level 4105. 4105s, if we fail that 4105, there's a lot of missing volume, quote unquote, gap volume to the downside. That brought us to 87. That brought us to 72. And I think 72 is kind of the last chance this week for the buyers to step in. But if we're going to see some real buying, if we're going to see some true buying, they have to accept above that 4130, right? They have to close above 4155 today, 70 today. So that's going to be some real buying. If we don't see that real buying, then you know what? We're going to diddle around 4105. We're going to close below 4105, and that's not going to be a bullish scenario by any means. So remember, understand your distributions, understand what you're looking for, the directionality of the market, and we'll see where these macro events take us. No one knows anything until it happens. So hope everyone has a great day, and all we can do is anticipate the move based on the information we're given. So we'll see you guys tomorrow, and have an amazing trading day. Oh, my hair's so poofy. All right, take care, everyone.